The past year was a hard year for everyone, but for automakers it was particularly grueling. Because of the recession brought on by the coronavirus pandemic, American automakers are in real trouble. With the worst financial crisis since the 2008 industry collapse looming, can Ford and GM survive the next Great Recession? All signs point to GM and Ford, two of the largest and oldest car OEMs in the United States and the purveyors of a collective 271,000 jobs in the states alone, are on the path towards bankruptcy yet again, largely because of the virus and the economic slump it has caused. COVID-19 plowed into the U.S. at full speed in March of 2020. By April, GM's stock was down 50% from where it started that year. Ford followed a similar trajectory, stock prices going from their 2020 high point of $9.21 per share in January down to a depressing $4.24 by April. At the beginning of the pandemic, Ford and GM, frankly, looked doomed. The reality turned out to be less dire. America took a more rolling stop approach to the economy in the long term than anyone could have predicted in those early months, meaning the economy fared better overall than many expected. Automotive companies benefited from this, and vehicle sales in 2020 came in at about 14 million, far short from the normal 17 million, but still much better than the 11 million figure analysts were projecting in April. This was massively helped by sales-saving techniques at dealerships, previously unheard-of deals like the hard-to-believe 0% interest rates offered by some desperate auto retailers. What's more, the shutdown of plants and manufacturing lines ended up saving many auto companies money, especially since selling continued. Still, the temporary bump in profit wasn't enough to pull GM and Ford out of the enormous debts incurred in 2009. For those unaware, the global economic collapse that followed the 2008 bursting of the housing bubble hit the big three American automakers, General Motors, Chrysler, and Ford, particularly hard. GM and Chrysler declared bankruptcy and had to be bailed out by the federal government. In practical terms, bailed out means for a limited time the government nationalized GM and Chrysler, buying out their stock market shares in order to reorganize the companies into functional and profitable enterprises and prevent hundreds of thousands of Americans from losing their jobs. While Chrysler was forced to merge with the Italian car brand Fiat, which has largely, if not completely, controlled the company ever since General Motors was gradually reprivatized, the Treasury Department slowly selling off shares to investors until the government owned almost no stock. Ford did not take a bailout, opting instead to accept a $9 billion loan from the government, pledging to return $14 billion to the government in the form of new technologies, a debt it is still paying off over a decade later. But government debts aren't what investors are so worried about in this most recent economic recession. Rather, it's the normal business debts GM and Ford allow themselves to rack up that are getting their shares labeled junk stocks. As of the fourth quarter of 2020, General Motors is $90 billion in debt. While many businesses purposefully incur debts as a business tactic, however, in GM's case, their EBITDA rate is nosediving. The EBITDA, an abbreviation for earnings before interest, tax, depreciation, and amortization, is a metric to track the collective growth of a company before considering outside factors. GM's EBITDA plunged an almost unbelievable 62% in 2020, meaning that if things don't look up soon, GM is going to find it nearly impossible to repay those debts, which may result in bankruptcy. It can be hard to peg Ford's exact financial situation because of the debt distribution practices the automotive company engages in. As near as we can tell, Ford carries $175.2 billion of debt in its balance sheet, an increase from 2019's $155.6 billion. Though the company likes to keep reserves of cash on hand, their total reserve would only cancel about $39 billion, bringing its net debt down to $171 billion. Ford's EBITDA has also fallen a hefty $2.2 billion over the course of 2020. Notably, Ford is only valued at $27 billion as a company and is either now only $6 billion away from or has already eclipsed the debt it had in 2007 before the major government assistance it received, depending on which sources you read. So, as you can see, we have a situation resembling the situation in the early 2000s and a recession that will last for at least another year. So, will GM and Ford make it to the other side of this one? Or is this the end of major American car manufacturers? Analysts from Morgan Stanley, a huge banking and investment firm, and a big player on Wall Street think Ford, at least, will survive the pandemic recession. To back this up, they cite the problems at Ford's top levels, which tend to panic investors, making them forecast doom prematurely. In March of 2020, Morgan Stanley predicted that Ford stock would make a comeback as an effect of the stimulus packages the government was releasing. Their analyst, Adam Jonas, was quoted at the time saying to CNBC, "You're going to see a boatload of cars later this year, and your stocks won't just recover, they'll multiply." This proved true after Ford stock reached their absolute low of $4.01 last March. They started a slow but steady recovery, resting at a comfortable $12.81 per share as of this recording. GM has experienced a similar bounce back, their stocks refortifying to a frankly shocking $56.33 per share, the most their shares have been valued in over a decade after bottoming out just last March at around $12 per share. The million-dollar question, or rather the $300 billion question, is whether this growth is sustainable or just another temporary boost after the several rounds of government stimulus and aid programs. The evidence suggests the latter. While we are seeing booming stocks from both of the two big automotive OEMs, this may well be inflated value. A look at the past decade reveals that before these past few months, GM stock has held relatively steady. In fact, its value barely climbed at all from 2010 to 2020. Ford stock has fared even worse, following a steady downward trajectory in the past 10 years, devaluing a total of 66% from its high point in 2010 to its high point in 2020. Recent booms aside, as debt goes up, just as profits and stock values go down or lay stagnant, GM and Ford seem to be on the slow glide path towards bankruptcy. The obvious cause of this decline is the one thing the mega corporations seem least willing to acknowledge: the surge in popularity of the electric car. The combination of rising anxiety and outright fear over climate change, combined with the major recent advancements in electric vehicle technologies, make dedicated EV companies an attractive competitor to traditional automotive manufacturers. Both Ford and GM CEOs, some of which have been fired in the meantime, have mocked or ignored the idea of Tesla competing with them in any meaningful way. However, while the traditional car companies see their stock declining, Tesla's stock has jumped from $3.84 when it launched in 2010 to $699 today. Tesla's profits have held steady enough through the virus not to cause mass layoffs, and Tesla's commitment to clean energy allows some users to recharge their cars via solar roofs, effectively never having to pay for gas again. In some parts of the country, buyers are encouraged to purchase non-fuel burning automobiles through government-subsidized rewards programs, or even have access to their own electric vehicle lane on busy freeways. The proverbial cherry on top is software updates pushed through to these cars of the future, enabling radical new approaches to the experience of driving. Things like autopilot features, full-size touchscreens, autonomous parking and summoning, and even possible futures in fully autonomous driving have investors excited and ready for revolution. The car companies of the past simply seem stale, outdated, even tone-deaf in comparison with Tesla's climate-conscious step into the future. Analysts suggest that GM, who has started seriously investing in electric vehicles as they slowly realize their mistake, will be playing catch-up with Tesla's tech for the next decade. All the while, Tesla will be drawing in former GM and Ford customers.